Alright guys, getting deeper into the system now. So these next couple of videos are going to be all about market context. This is the first core pillar of the CLC trading system. And when we're doing our contextual analyses, the main and the most important instrument that we are using is the VIX. So this video is going to be all about defining the VIX. The next video will be all about how we can actually apply the VIX within our own trading. So the volatility index is not very difficult to understand. I've simplified it for you guys in this video, so it'll only take just a bit, and you guys will have a very good understanding of what the VIX is representing, what it means, what changes in the VIX means, and then we can get on to application. So let's get into it and yeah, really get into this system now. So through a contextual analysis, first what we're doing is we're determining whether bulls or bears hold the advantage by monitoring the relationship between ES and VIX. The volatility index is always the first contextual instrument analyzed, as this tool gives us our directional bias within ES. So the first thing that we're always looking to do when we approach markets is establish a directional bias. We want to understand whether bulls or bears have an advantage over one another, which side has an edge within the market. And the way for us to do that is to look at the relationship between ES and the VIX. So pretty simple stuff to understand. VIX gives us our directional bias, and before we talk about how that happens, we have to define it and understand what it means. So this picture right here is the inverse volatility index. That is what I use. So it's essentially just a flipped version of the standard volatility index. You guys are more than welcome, obviously, to use the normal VIX, but just know that I use the inverse volatility index, and this is really just for readability purposes. All right, so let's get into the definition here. So the VIX is the volatility index. Obviously, we use the inverse, as we've said. And so what this instrument is doing, what the volatility index is doing, is it's gauging the implied volatility of the S&P 500 over the next 30 days by measuring the demand for puts and calls within the SPX options chain. So I understand that that was probably a bit confusing. Before we move on to this part, let's break this down a bit. So don't get so strung up on this. This is not super important to understand right now, but do understand that this is the formal definition and that this is part of what the VIX is measuring. But mainly what we're concerned with is that the volatility index gauges the implied volatility of the S&P 500, and the way that it's doing that is by measuring the demand for puts and calls within the SPX options chain. So you guys might be like, what does the SPX options chain have to do with implied volatility of the S&P 500? And so if you guys don't understand already, what you have to know is that SPX is simply the ticker symbol that is used to represent the S&P 500 index on most trading platforms. So SPX is the ticker symbol that is used to just represent the S&P 500. And so moving on, institutions such as banks, hedge funds, proprietary trading firms, market makers, options desk, portfolio managers, etc. These large players within the market widely participate in the SPX options market. So we'll make this say option chain / market. So yes, understand that the SPX options chain, which again is just simply the ticker symbol that's used to represent the S&P 500 index itself, is used by these large players. It's like, okay, why does that matter? So moving on. When institutions actively hedge, well, what I should say before we get into the next part, which is something that you guys understand already, is that institutions trade with such large size that they essentially are the manipulators of price movement. And when they get factored into the market, they are the ones that are engineering price levels. They are getting in with very, very large amounts of size, and so therefore they disrupt the supply and demand equation, and they actually cause price to move up and down on a very, or for the most part. So when institutions are actively hedging through puts and calls in the SPX options chain, this influences the implied volatility of the S&P 500. So puts and calls, just think of puts as sell orders, calls as buy orders. So when these institutions are buying and selling puts and calls within the SPX options chain, this influences the implied volatility of the S&P 500. And that makes sense, right? If an institution is buying puts and calls aggressively, therefore the volatility or the implied volatility is going to change within the S&P 500. So changes in implied volatility are reflected through movements in the VIX. A declining in the inverse volatility index, excuse me. Remember, I always use the VIX, or the inverse VIX. A declining VIX indicates expanding implied volatility, and a rising VIX indicates contracting implied volatility. So we're going to break all of this down into a very easy to digest definition down here, but first let's look into an example real quick. So just to gain more perspective on what we're talking about here, if an institution, if Goldman Sachs, let's say, if Goldman Sachs is aggressively hedging into put positions in the SPX options chain for whatever reason, maybe it's for insurance, maybe it's because they actually want to get active in a short position, then that activity, that decision that is followed out by Goldman Sachs to aggressively hedge into put positions will therefore increase the implied volatility. And so when the implied volatility is increasing, this causes the inverse volatility index to move down. And so when the inverse volatility index is moving down, what that's signaling to us is that implied volatility is expanding within the S&P 500. And so the same exact thing is true on the flip side. If Goldman Sachs is hedging into call positions or buy positions in the SPX options chain, then implied volatility is going to decrease. So that decrease in implied volatility will cause the inverse volatility index to move upwards. And when the inverse volatility index is moving upwards, this signals that volatility is contracting in the S&P 500. And so in the next video, when we talk about applying the VIX, we'll talk more into how expanding volatility or contracting volatility favors either a bullish or bearish environment, but we're not getting too far into that yet. That's for the next video. So to tie in what we've talked about so far, understand that the reason that the inverse volatility index, or the volatility index, same thing, is closely tied together to ES directional movement, and the reason that the volatility index is used to establish a directional bias within ES is because that the volatility index is derived from pricing within the SPX options market, which represents the S&P 500 index. Remember, SPX is simply the ticker symbol for the S&P 500 index. And so within this market, within the SPX options market, institutions are actively hedging risk through put and call positions. And so changes in that hedging activity are going to therefore alter the implied volatility. And when the implied volatility is changing, this is reflected through movements up or down or sideways in the volatility index. And so as implied volatility expands or contracts, the value of the volatility index will adjust accordingly. It will move up or it will move down or sideways. and these shifts will often correspond with changes in directional pressure within ES. So again, now we're going to get into how expanding volatility, or if expanding volatility favors a bullish or bearish environment, and if contracting volatility favors a bullish or bearish environment. So that'll be video 5. And yeah,